So since listing, we've delivered for investors a return that's exceeded the minimum target return. So the minimum target return for MXT is the RBA cash rate plus 3.25% net in the hands of the investor, with income paid monthly. Distributions are paid monthly. And so we've exceeded that minimum return. And I guess importantly for us, what we're seeing with our most recent capital raising is that we believe that it will enhance the product for investors, in that we believe it will provide greater levels of liquidity on the exchange, and it's also resulting in a lower cost base for investors. So the cost base will go from 75 basis points down to 63 as a result of this capital raising. Our deal pipeline is very strong. So the asset class that we invest in is predominantly a bank-dominated lending market, and so for us, that's a very large, significant market. It's around about 1.2 trillion in size, but predominantly sit on bank balance sheets. And so for us, when we're raising capital, we're obviously able to deploy that in direct loans to Australian companies, providing our investors with an exposure to those companies. So the risks and the returns associated with directly lending to those companies is what we're able to deliver for our investors. Importantly, with MXT, investors gain the benefit of a high level of diversification. So MXT is diversified across a portfolio of in excess of 100 individual loans, which we think is a means to lower investors' risk as you're diversifying their risk across the credit spectrum, across individual borrowers and across industries. We're doing an entitlement offer which allows existing unit holders to increase their investment in MXT. The entitlement is for one new unit for every 1.8 that they hold currently. And then to the extent that existing unit holders elect not to take up their entitlement, then we're able to attract new capital from new investors through the shortfall offer. And so we'll seek to raise a total amount of 400 million, issuing around 200 million units at $2 per unit, and the capital will be invested in our 3 underlying wholesale funds, which in turn allows us to diversify investors' investments and exposure across a diversified pool of direct loans to Australian corporates. So if I think about an investor buying units on the exchange in MXT, they can buy units in the exchange and they get immediate diversification across a portfolio of in excess of 100 loans. Those assets are all predominantly floating rate, and so the returns to the investors reflect floating rate exposures. They're short dated, which we think is attractive for investors because the short dated nature of the loans that we provide, we think lowers investors' credit risk, it lowers their market risk, and it drives enhanced return opportunities as we charge borrowers additional fees. And so all of that combined with a highly liquid, capital stable unit price, we think is an attractive product for the exchange.